Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So this is a chart now of what we call the US dollar index cash index. And I want you to notice that the cash index here in October kind of bottomed out close to 75, but it never really reached an area of support here. So it kind of turned when the futures contract turned, and you'll see that happen quite a bit. And I just wanted to point out that if there is going to be another shot at a new low in the dollar secular bear market, this area of support that we have down here for the cash index may actually provide some kind of short-term support going forward. Okay. So back in October, everybody in the world was bearish on the dollar. The UN downgrading the dollar. The Moody's came out and threatened to take away the USA's triple credit rating. And we said that that's usually a contrarian indicator. Unfortunately, though, one way to try to get a trade deficit or a current account balance deficit back in order is to allow your currency to depreciate. And of course, you'll never hear anybody at the Federal Reserve say that. But that just happens to be the way that we correct these imbalances in our currencies. And I also said at the time that the low interest rates that we were having were probably inflating new bubbles in the stock market and the commodity market, and that eventually if inflation could be a threat. Okay. The dollar purchasing power. I found this chart here, and it's pretty stunning. During the periods where we actually were on some kind of a gold standard, we actually had purchasing power much, much higher than we did now. And ever since we came off of that gold standard in 1971, by 2004, the US dollar had lost 92% of its original purchasing power compared to this index from 1792. So as you can see, we haven't fared very well as far as our currency goes and as far as the money in our pocket goes for years. I also said back in October that the dollar's futures contract was very, very close to the origin of the rally from 2008. And there was a potential for a large short covering rally at that time. At the same time, the volatility index, the VIX, was very close to yearly lows, indicating that the market was showing very little fear. And another old saying, the market likes to catch as many people on the wrong side as it possibly can. And of course, that means that everybody is being short the dollar. And, if there's nobody left to sell, there could be a spectacular rally from that point. And in the equity market, the only thing we really haven't seen yet is some kind of an excessive blow-off top. But the equity markets are rallying and making new highs. So that's still a possibility for this current cycle, too. We were testing that support area here at that point in time back in October. In November, we actually had a little rally in the end of October, and then we made new lows here in November. And then we started another little rally in November. In December, we actually started to rally pretty significantly. And notice the large volume down here, which is once again at this candle right here in November. The largest volume candle that you see on this chart is this November candle, and that's usually a sign that the novices are entering the market here. And they're selling after a big drop in price and right into an area where we definitely had some kind of a strong rally the last time we were trading down there. And so now this chart here is where we are in April. So we can see that we've had a pretty significant counter trend rally or originating out of that area of support. And of course, if we were going to enter there, as we teach our students to do, we very, very simply would place a stop loss, protective stop loss, just below these lows, just in case price does want to make a new low. You never know if price does want to go lower, and eventually it could. So as a way to protect yourself, we place a protective stop loss below here, and this becomes our risk. And then, of course, our reward is the opposite picture. So our target would be on something like this, would be way back up here. So this is something that we do look at quite frequently at the Online Trading Academy. The fundamental things that happened since October, we've had the Dubai debt problem in November, and of course we had rating agency Fitch downgraded Greece in December, followed by Moody's and S&P. We had the Irish banking system downgraded by S&P in January of 2010, and then we were introduced to the PIGS, the governments of Greece, Portugal, Spain, and Italy, and you can throw Ireland in there too. And their markets were under attack from the large deficits that those countries have too. But prior to all of this fundamental information, we still had, as you can see, we still had a support area and the potential for some kind of a counter-trend rally in the dollar. And so we could plan that trade out. And of course, when all this other fundamental information hits, it's helpful to our position at that time, but at that time, that we planned our trade, nobody knew that we would have these issues, just like nobody knew that Lehman and Bear Stearns and a few of the other companies were going to go out of business in 2008. So I just want to point out now at this point that as we're charting our opinion of the U.S. dollar, and we're going to look for some recognizable patterns, I'm actually going to go through some of the patterns that we teach in the Online Trading Academy, some basic patterns, which indicate reversals or continuation patterns, okay? And these patterns tend to repeat over and over again because they are based on emotions, but they have to be identifiable and therefore measurable. But the trader, the person who's actually going to use these chart patterns, has to also understand their personality. They have to determine if they're able to buy strength or sell strength, buy weakness or sell weakness. Or some traders can rarely, not too many of them, some traders can do both. Okay? So in other words, are you able to buy strength when you see a breakout, or are you more comfortable buying weakness, some kind of a pullback? Are you able to sell strength, which means a rally into some kind of a resistance area, or do you prefer to sell when price breaks down and makes new lows? You have to understand that because it's very important that you use this information when you formulate your entry types. So some of the trend continuation patterns that are bullish would be called bull flags, rectangle periods with upward breakouts, ascending triangles, cup and handles. And we also could have reversal patterns, inverted head and shoulders, double bottoms. Every now and then, too, you can see something that looks like an ascending triangle at the bottom after a sell-off, which, again, would indicate accumulation. People paying higher and higher prices to buy an asset. Sellers selling, but buyers willing to pay higher prices. So when you see these patterns form and you combine them with the 4 stages, then you can actually use this information to trade not only trading ranges, but trends. So on this particular chart here, which is the dollar versus the Japanese yen, just recently here, we start off seeing that we have a bullish flag, starting off with a flagpole, and a bit of sideways profit taking after the flagpole and a breakout to the upside. And following that pattern, of course, we have a period of rectangle trading, sideways trading in a trading range, with another breakout to the upside. So these are trend continuation patterns, and they're bullish.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.